If you're feeling anxious about the economy right now, you're not alone. As of mid-2025, at the time of recording this, it's becoming increasingly clear that we're either in a recession or on the brink of one. According to the U.S. Bureau of Economic Analysis, otherwise known as the BEA, real GDP growth slowed to 1.6% in Q1 of 2025, underperforming expectations. The Conference Board's leading economic index has declined for 23 straight months, the longest streak since 2008. At the same time, consumer sentiment is sliding. The University of Michigan's Consumer Sentiment Index dropped to a 6-month low in April, driven by inflation fears and housing unaffordability. But the bigger question isn't just, are we in a recession? It's what happens after one. If you can understand the patterns, historically, psychologically, and financially, you can stop panicking and start preparing. So what actually is a recession? A recession is typically defined as 2 consecutive quarters of negative GDP growth. However, the National Bureau of Economic Research defines it more broadly as a significant decline in economic activity that is widespread and lasts more than a few months. Recessions don't just appear out of nowhere. They build slowly, like cracks in a dam. You start seeing layoffs in specific sectors like tech or manufacturing. Companies start tightening budgets. Then you see it reflected in consumer spending, housing starts, and loan defaults. Current indicators of a recession are, as mentioned before, GDP growth at 1.6%, so it's trending downwards. Inflation at 3.4%, which is still above the Federal Reserve's 2% target. Fed funds rate still above 5.25%, with no rate cuts expected until Q4. Jobless claims rising gradually, currently near 265,000 weekly. Global growth slowing with weak manufacturing data in China, Europe, and Japan. So even without the technical label, these are the exact conditions that precede or signal a recession. So what actually happens to markets during recessions? So stocks usually drop before a recession is official. Historically, markets start declining around 6 to 9 months before GDP turns negative. Investors don't wait for confirmation, they act on expectations. That's why headlines always say, the market is forward-looking. In many cases, by the time the media calls it a recession, the market has already priced it in and is thinking 6 months ahead. But markets also recover before recessions are quote-unquote over. It's weird but true. The stock market often bottoms out before GDP starts growing again. It reacts to expectations of recovery, not the recovery itself. So here's some historical market data. 2001 to 2002 was the dot-com crash. NASDAQ was down 78%, S&P 500 down 30%, and recovery took over 7 years. 2008 to 2009 financial crisis, S&P 500 was down 57%, and it only recovered after about 4 years. The 2020 COVID crash, S&P 500 was down 34% in 33 days, but it recovered within 6 months. This is why market timing is dangerous. When things feel worst, the rebound is often right around the corner. Here's a fun fact for you. If you missed the 10 best days in the S&P 500 over the past 20 years, your return was cut by more than half. Most of those days happen during downturns. And so, what actually happens to the economy after a recession? The first thing is that the GDP usually bounces back pretty strong. Once the storm clears, economic growth often returns fast. Companies that downsized ramp back up, supply chains unclog, consumer demand returns, and central banks start loosening policy to kickstart momentum. Average GDP growth in first year post-recession is usually above 4.5%. Pent-up demand from consumers often acts like a compressed spring, especially after high inflation periods. Number 2 is unemployment peaks, then falls. Job loss is one of the most visible symptoms of a recession, but it's also one of the last indicators to improve. Why? Well, because businesses are cautious. Even as things pick up, they want to make sure the recovery is real before rehiring. Still, historical recoveries show this pattern. 2009 peak, 10%, fell to 6% in 3 years. 2020 peak, 14.8%, fell to 3.5% by late 2021. And 1982 recession, unemployment hit 10.8%, then fell sharply over the next 2 years. And the third thing is that consumer confidence rebounds. Confidence doesn't just improve, it often surges after long periods of fear. Stock market gains often fuel optimism, wage growth returns, and people start buying cars, homes, and traveling again. So this creates a feedback loop. Confidence drives spending, spending drives GDP, GDP boosts employment, and that's the loop. So here's what smart investors do during and after recessions. They stay invested. Even if it feels hopeless, history shows the biggest gains often happen during recoveries. One way to think about it is that the market is a voting machine in the short term and a weighing machine in the long term. You don't need to predict the exact bottom. You just need to stay in the game. Another thing they do is they dollar cost average into quality. When stocks are cheap, That's the time to accumulate large cap dividend stocks, broad market ETFs, sectors poised to benefit from the recovery like tech, industrials, financials, and real assets like gold, tips, REITs. They also reassess risk. Recessions are when people discover they were taking more risk than they could actually stomach. Smart investors use this time to realign with their goals, not react out of fear. And the last thing they do is they play long games. As Warren Buffett said, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. In terms of global stuff, recessions are rarely isolated. Right now in 2025, Germany's GDP shrank by 0.3%, China's exports dropped by 6.2%, and Japan's PMI remains in contraction territory. But in the case of a global recession, global coordination often follows in the forms of central banks reducing interest rates, governments increasing stimulus spending, and trade activity rebounding as demand improves. In previous cycles, emerging markets and tech sectors often outperform once global liquidity returns. So just some final thoughts. Recessions are part of the cycle. They cleanse the system, reprice risk, and prepare the ground for new growth. The market anticipates recovery before it feels real. If you stay rational, diversified, and long-term focused, you'll often come out stronger on the other side. Your job isn't to predict the next move. It's to stay in position when it happens. And here's a couple quotes for you guys, starting with Robert Arnott. In investing, what is comfortable is rarely profitable. And another one by Shelby Davis. You make most of your money in a bear market. You just don't realize it at the time. Well, that's it for now. Thanks for watching. Like and subscribe for more. And we have a Discord and newsletter linked below. Again, thank you so much for tuning in, and I'll see you guys next time.